Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome. You're listening to Destination Retirement. My name is Robert Kuhn, president, founder of Kuhn Capital Partners, independent registered investment advisory firm, SEC fiduciary, located in our headquarters, Oak Brook, Illinois. So many of you know that we are in Oak Brook. We are off of 22nd Street, looking right at the mall. If you know where the Fidelity building is, or the Fidelity office is in Oak Brook, we are actually right upstairs on the 5th floor. So I want to thank everybody for joining us. A blast of snow has happened. Hopefully winter is treating everybody well. This show, let's say, okay, we've got a few more weeks till the end of the year. We've got a lot to go through, a lot to make sure that we're touching on. We're going to talk about the banknotes. We're going to talk about tax strategies. We're going to talk about kind of the market and what I see going on and where I think the industry is going. Well, maybe not so much the industry, but the market, because there are a lot of headlines out there. So if you have listened to the show for any length of time and you want to get on our calendar and learn more about what we're doing, we would love to welcome you into our office or have an initial consultation over Zoom or a conference call, whatever works best for you. You can certainly give us a call at 630-492-1912, 630-492-1912, and we can get that set up. So if you haven't watched The Big Short, I think it's we call it a film rather than a movie, but I think it's something that you have to watch. And Michael Burry, who was one of the managers in hedge fund managers prominently displayed in the movie, really has come out and been saying an awful lot about this market. And again, as you know, when we look at opinions, we can find two people that are equally credentialed that have the exact opposite opinion, and the reality is they can both be right. So we don't know where the market is going, but what I do know is that most advisors are not setting their clients up to be able to win in an up market, a down market, and a sideways market. And I think that is the job of an advisor, and that's why we do what we do at Kuhn Capital Partners when it comes to our overall asset allocation. Asset allocation means significantly different things to many people. Unfortunately, we're sitting with a new client. Great client. He has what people would consider to be a significant sum of money, and they're 100% mutual funds. And I'm thinking to myself, wow, why in 2025? With an asset base over $1 million, and this one is a multiple of that, many multiples of that, but that's not really the point here. But why have mutual funds and in a taxable account? And I give this individual a tremendous amount of credit because they're recognizing that the capital gains that they are incurring from the mutual funds and not even having sold the mutual funds, because the mutual funds actually own the stocks and they have to, do the capital gains each year. And he looked at, it was costing him, by his math, $400,000 or $500,000 a year. And you extrapolate that out year over year over year, you look at the opportunity costs there. And these are such basic topics and, in my opinion, failed investment strategies that we don't even talk about anymore. But there's still a tremendous amount of advisors that utilize mutual funds and taxable accounts. They're just not tax efficient, not transparent. Everything I would not want in an investment. And so I guess what I'm getting at is if that is you and you are concerned about lack of transparency, lack of customization, lack of tax efficiency when it comes to investing, then we really do need to talk. 630-492-1912. But going back to Michael Burry, he said recently he's expecting a prolonged market-wide sell-off that's worse than 2000. And as you remember, 2001, 02, markets were down 3 consecutive years in a row. That's always been my concern. It's not necessarily a big, 2008 where we see the markets have the significant sell-off immediately. Generally, it's bought right away, and then we kind of see this V-shaped recovery. My concern as an advisor, as a fiduciary, our concern as financial planners and everything that we do at our firm is what happens if we see consecutive years down in the market. And, as Charlie Munger said, the greatest mistake of investing is interrupting compounding unnecessarily. And if you think about that, that's just a great kind of way to live when it comes to investing is interrupting compounding unnecessarily. And I would venture to guess that most advisors and I know this just because I've been in the business for 25 years now. At least it's my belief that most advisors have nothing in place inside of a portfolio that can actually do well when the markets don't do well. And that's where the bank notes come in, right? I mean, the bank notes, are what they are. We priced another note. Obviously, we priced significant amounts and quantities of notes. I don't know where we're going to end up the year, maybe 60 million in new issuance, and hopefully we'll do double that next year. But you are, a bank note, a structured note, a enhanced income yield note, call them what you want. We just call them bank notes. Every bank has a little different name. But it's a contract issued by a major bank. So think JP Morgan, Citi, Bank of America, Morgan Stanley, UBS, et cetera, that is engineered to give you a very specific return profile based on the markets. And so what does that mean? That means that if the markets are not down, and when I say the markets, the indexes that we utilize that make up the note, which is generally the S&P, the Russell, and the KRE, or we'll put in the Dow occasionally, but the indexes that make up the note, as long as they're not down 30%, you're still getting paid. And so we priced the note almost 13% this week. I think it was 12.9. But you have you have 30% downside from here, right, to still get over 1% a month. I mean, think about that, 1% a month with 30% downside protection. And I can't stress that enough, that if we do see a prolonged down market, and the markets don't have to be down significantly, 10, 15, 20, whatever, what do you have in your portfolio that can still, again, not interrupt compounding unnecessarily? What do you have in your portfolio that'll still generate returns? And obviously, one of our biggest competitive advantages are the bank notes. And when you can get, an obligation, contractual obligation, a prospectus item from the biggest banks that the rules of the road before you invest, it clearly just makes so much more sense, in my opinion, than having a debt asset in bonds. And that's what the bulk of traditional advisors are still utilizing, or these lifetime income annuities, which is, potentially even worse, in my opinion, when it comes to keeping up with inflation. So 630-492-1912, because I see the statistics just like you do. Foreclosure surged 20%. Read that this week as homeowners are falling behind on mortgages. I mean, that to me is an issue. You look at, since 2020, credit card debt is up 50%. I mean, again, that is an issue. And Americans, many, are drowning in debt, and foreclosures, evictions, they're, potentially approaching. You've got private equity, this private credit space that nobody really knows ultimately, how that is going to shake out. 25% of buy now, pay later users are relying on those services to finance groceries, which, thank goodness that they can, but you have that really just starts to tell you, where are we at in the market, where are we at in the cycle. And the two biggest things that I've always found that when I say the financial advice business is broken, which are, the advice business, like people like myself and my team and my firm that give, advice and hold ourselves out as, qualified, credentialed professionals, are the lack of tax planning, which we're going to certainly talk about that next segment a lot, and the lack of having strategies inside of a portfolio that can still deliver positive returns in negative markets. And if you ask your advisor, what do we have inside of our portfolio that as long as the markets aren't down, say 30%, like the banknotes that we use, when we say market, we're talking whatever indexes that note tracks. But what do you have inside of your portfolio for me, Mr. or Mrs. Advisor, that can still deliver, a double-digit return even if the markets are down? And we've got 30% downside buffer before we have to worry about skipping and missing a payment. And that strategy may, look not appealing when the markets are up 20 to 30 to 40%. But I promise that if the markets, and if we do see a period like 2000, 2001, 2002, where the markets are down subsequent years in a row, or just down in 1 year, as long as they're not down more than 30%, and you can still make money with some of your portfolio, I think it's a must. I absolutely, positively think it is a must. And but we just don't see risk management. We don't see risk management inside of traditional portfolios in that $1 to $10 million, $1 to $15 million space. Because, again, it's yield to the broker, right? Put something basic together, explain away losses, and then just go capture more money so my fees, my revenue can increase. And again, it all looks fine and it all works until the markets don't work. And at that point, that's when people start to really, really get nervous. And then the answer is, well, just sit and wait. It'll come back. So we'll talk more about that after the break. 630-492-1912, 630-492-1912.
Retirement is the destination, and getting you there is what we do. Whatever comes your way, we've got you covered. We're dedicated to providing investment management and strategic wealth planning that are right for you. Simply put, we strive to be our clients' trusted advisor. We've been helping families, business owners, and entrepreneurs just like you get ready for retirement for over 28 years. To talk with Robert Kuhn and his team, give him a call at 630-492-1912 or find out more at KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent SEC registered fiduciary, headquartered in the Chicago market, in Oak Brook, right across from the Oak Brook Mall. That does not mean that we don't have clients throughout the country, because we do. We're in the Dallas market pretty significantly. We're in the Panhandle market of Florida pretty significantly. We are looking to kind of expand our reach as a firm just because our message is so well received. And I think when you look at kind of what we are doing and the differentiation that we're bringing to the table, not only on the financial planning side, when we can model out Roth conversions, even though you don't think that you can convert because you make too much money or your IRA is too big, well, let us model that out into age 95 and let us look at how we can, take advantage of Bison II and the energy strategy and utilize those tax benefits to help you potentially either offset, significant active income, or if you sold a business, you sold a building, you have concentrated stock that you want to diversify out of because you're concerned about the market, but yet you don't want to pay the capital gains. let's talk about a strategy, and let's talk about how we can incorporate Bison 2 in the energy strategy to greatly reduce your taxable income. And just so you know, I can't provide tax or legal advice. I'm not licensed to do that. So best practice is always talk with your trusted professional. But 630-492-1912, 630-492-1912. If you need anything on the investment side, certainly just give us a call, and we would love to start that conversation and go down that path of, comparing and contrasting, what we're doing versus what you're currently doing. And I can promise you that in most instances, we're going to win. Not are we going to win just because I think we're going to win? I just look at how people are investing. I look at the risk management that most advisors are including in clients' portfolios, and they talk well. They talk a big game. They talk about asset allocation. They talk about time in the market. I don't know what time in the market really means. I don't know how that should justify away losses. The markets always go up over time. That is not disputed. Nobody even can dispute that. It's just a simple chart. Look and read at it, but it's also not disputed that the markets can go down, and they can go down significantly. They can go down and stay down longer than you anticipate. And again, Charlie Munger, Warren Buffett's right-hand man, the late Charlie Munger, said the key to investing is do not interrupt compounding unnecessarily. And I want you to really think, what do I have in my portfolio that if the markets do go down, that will not interrupt compounding unnecessarily? What do I have that'll make money? What do I have for a bucket of my money that'll make money to offset my losses on the equity side? That is what I want to ingrain in people's minds, and that is why I think we are raising and people are hiring us at a rate that, to be honest, I didn't expect. And I'm glad. It's great because I think, we're doing a service to the general public, which, when we look at kind of the bank notes, again, we priced a bank note last week, 12.9% with 30% downside protection. If you haven't heard about it, if you haven't learned, if you want to compare that to your bond strategy, goodness, please, now is the time to do it with this market. 630-492-1912. Okay, taxes. So we have till December 31st to affect your tax bill for the year. We wish people would start to talk about planning again. We go in and we try to change people's minds, attitudes, and the way they think about investing. And I did forget a statistic just a minute ago when I said the markets, and when we have, advisors that talk about, the markets ultimately will come back. Of course, they're going to come back. Again, a good, tried and true statistic that I use often when I speak publicly or I do it on the radio or we meet with individuals. It's a statistic that you can actually see on your own. Go and look at Microsoft if you had bought it in 2000. Look at how long it took you to get back to even reinvesting your dividends. 14 years. Think about that. 14 years. So when an advisor says to me, because we work with other advisors, we have decided to open up Bison 2, which we'll talk a little, about, here in a minute. So if you're a registered investment advisor, we'll sign a non-solicitation, so you don't have to worry about us talking to your clients about asset management. Everything comes from you. Again, everything we do is institutional transparency, but the Bison 2 strategy we have opened up to other advisors. So if you are an RIA and you want to learn about it, just, obviously reach out 630-492-1912 and we can go over it. But it took you 14 years to get back even. And that is a time in the market that I don't know if we'll repeat. Nobody knows if we'll repeat it. It's not used as a scare tactic. It's just used as a data point that when we look at portfolios, we want to stress test a portfolio to see if you could handle that type of a market. And in that type of a market, the bank notes are massive home runs because you've got 30% to get generally double digits. We're back almost 13% is what we're pricing on the bank notes. Again, 12 to 13, we've kind of been in this range. And so that's something that, I want to make sure that you're paying attention to. But on the tax side, you have till 12/31. Paul Tudor Jones, Google him, you'll see who he is. His name speaks for itself, Paul Tudor Jones. But you look at interest expense, and he had an interview on CNBC this past week, and interest expense is now the second largest government expenditure. all roads are going to lead to inflation is his opinion. I believe it. Commodities are ridiculously underowned. There are a lot of people that are saying they wouldn't touch the NASDAQ or growth stocks because inflation kills growth stocks, and the NASDAQ obviously is full of them. I am not quite sure that I 100% agree with that. We have to do a little bit more research on that, but I do want to know what your downside is, what your hedge is to a down market. Again, that's a simple question to an advisor. What's my hedge? What's my downside? And if the advisor cannot answer it immediately, like us, the banknotes, boom, 30% downside to still make 12, to still make 13, to still make 11, whatever that note is pricing, then you owe it yourself to talk to us about how we can incorporate those strategies. And then tax planning. We're talking about tax reduction, significant tax reduction. When you look at the investment advisor space, generally the $1 to $20 million space of investable assets, there just isn't any proactive tax management, proactive tax reduction strategies. We're not talking tax loss harvesting. We're talking strategies like Bison 2, our energy strategy that is still open. You still have until 12/31 to reduce your taxable income for the year. That can reduce your taxable income by $80,000, $90,000 for every $100,000 invested. Think about that, $80,000 to $90,000 for every $100,000 invested. That's active income. The tax code in energy is significant. Here in the Midwest, in the Dallas markets, most people know about oil and gas. The Panhandle markets, it's probably only 5 to 10. In the Chicago markets, very, very few. And I understand why, but again, our job, we're changing that. So this is our fund. My partner is the managing general partner of this fund, and it is so simplistic. It is so straightforward. We're simply investing in the number one oil field in the world, the Permian Basin in West Texas, tier 1 location, and investing in the deals, the drilling programs of the Exxon, Chevrons, Conocos, Occidentals of the world, the majors, the biggest and the best. This isn't wildcatting. This isn't speculation. Conoco is not going to spend $200 million, $150 million unless it's a near certainty that they know it's going to work out. And oh, by the way, Mr. or Mrs. Investor, you get significant tax benefits. Last year it was over 90%. Year before that, one of the funds was upper 80s. One of the funds was mid 80s. That's per $100,000 invested. Think about that. Put $1 million in. You're going to have significant tax benefits to utilize as you see fit. So again, anytime I mention taxes, I don't have a tax license. We're not licensed. We can't give tax advice. So this is for informational purposes only. You can do the tax. You can chat GPT the tax code on the IDCs, TDCs, and the depletion allowance just like I can. Simple question to your CPA. This is a very, very simplistic, straightforward strategy. And when we can bring institutional level transparency, the fund is on the custodial platform of Charles Schwab. Doesn't make anything saying that the fund is good or bad, right? It's just that we've met that due diligence criteria to be on the custodial platform of Charles Schwab, so you can see it on your statement. That is something that we did, that we went through, because that's what our clients want. And we do have institutional level transparency. We do have a fund administrator / transfer agent. We do have independent third-party oil and gas accounting. We do have independent audits on an annual basis for all of the funds. This is $1 billion strategy for us over the next 7 to 10 years. This isn't a 50 to 75 million and hope it works out. We have opened a market to individual investors in the $1 to $20 million space that has not been there before. And believe me, the amount of deals that we look at and why we created what we created and created that exit in the fund of a 3 to 5 year exit, it is just something that if you're a higher net worth investor, it's something that you must look at. So 630-492-1912, 630-492-1912. But again, I think we're trending. We don't know what the taxes, the end of what they'll ultimately end up this year. But I feel very, very confident that it's going to be between $80,000 to $90,000 again for every $100,000 invested. And you get the tax benefit for the entire year as long as you invest by 12/31. So if you're interested, get in the data room. We created a data room, request it. We've taken transparency to a whole nother level. And so get access to that data room. So 630-492-1912. More after the break. Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. I host this radio show to give you, the investor, education, to give you, the investor, the ammunition to make sure that you are not interrupting compounding, as the great late Charlie Munger said, unnecessarily. And I really want you to think about that. I want you to think about that. I want you to challenge your advisors. If you're managing the money, then you need to challenge yourself. How is your portfolio crafted to not interrupt compounding unnecessarily? What do you have in your portfolio that can still deliver positive returns even in negative markets? The banknotes, the banknotes, the banknotes. Everybody has heard us. We've done just a tremendous amount of new issuance this year, $60, $70 million. When we can get a contract, a prospectus item, I consider a contract a prospectus. I mean, that's what the bank is going out and filing with the Securities and Exchange Commission. But when you can get a bank like J.P. Morgan, Bank of America, Morgan Stanley, UBS, BMO, BNP, BBVA, Bank of Canada, the biggest, the best banks in the world, that can give you a strategy that, as long as the markets don't drop 30%, those are the ones we use. Now, again, we customize. We have 2 tiers of banknotes. Again, everything we do is to try to provide a level of certainty that most advisors simply can't. Most advisors simply talk about, well, don't worry, you're diversified. If the markets go down, you don't need the money, it's going to come back. Well, duh, the markets always come back. But why am I hiring you? What are you doing that I don't know that I couldn't do on my own? That's what we are doing. That's what we do at Kuhn Capital Partners. That's why the radio show is expanding. That's why our client base is rapidly increasing, because we're doing that. And it is different. So 630-492-1912, 630-492-1912. And you probably hear the passion in my voice, because that's what we get up and do every day. And we get up and do every day things that just other people don't want to do. And when you listen to the radio, the bulk of radio are annuities. That's what the bulk of radio is. It's an annuity pitch wrapped up as an asset management pitch. And people are selling these lifetime income annuities, and individuals don't know what they're buying. And when you look at where we think, I guess I think, but Google Paul Tudor Jones. Google that name. And when he comes out and he says that the greatest, well, this isn't really disputed, the second largest government expenditure is the interest expense on our debt. And he believes, I believe, many believe that all roads lead to inflation. And if inflation continues, if inflation picks up, and if inflation runs hot, what are those annuities going to do for you? That is the problem. And the problem with these lifetime income annuities is you're getting a fixed payment that is never going to go up. And what is inflation going to do to that purchasing power? People want to say, we don't like annuities, they don't like annuities. That couldn't be further from the truth. One of our greatest strategies in our protected growth bucket is a 5-year annuity. Absolutely. 5-year annuity, we love it. No income relation, no guaranteed income. Here's what the guarantee is. Your guarantee is your worst year is 0, and it's tied to the S&P 500. So not these fictitious indexes that these people, these advisors, these other advisors on the radio show are showing in front of a client. If you need to buy an annuity based on an illustration, don't buy it. That's it. Do not buy it, because these illustrations are showing hypothetical back-tested data that will never happen, because we can take that same illustration that you're being shown and show you in the real world what it did the last 2 to 3 years. Even though the insurance company is back testing it for 10 years, and the advisor may not be telling you it's not actual real performance, it's hypothetical performance that is computer generated based on how it would have done, simulated performance. Newsflash, I've never seen a bad back tested strategy, or else it wouldn't be sold, but we can show you what it's done actually in the last 2 to 3 to 4 years. And so these lifetime income annuities, you have to make sure you know what you're buying. So people say we don't like annuities. We get tagged as the annuity haters. No way. We love a 5-year index annuity, 0 cost, zero downside risk, short term, great alternative, fits very nicely in our protected growth bucket. And guess what it's tied to? It's tied to the S&P 500 on an annual basis. It is that simple. And currently, it can change, of course, but currently we're getting the first 10.75% of the S&P on an annual basis. So if you're worried about the market, if you want to protect, if you are near retirement and you want to make sure that you have some protection in place, that is a phenomenal strategy. Again, pays us a commission. It's irrelevant to me whether you, or not irrelevant because it doesn't really make any sense, but we are product agnostic, I guess is a better way to look at it, because we look at asset management in really four buckets. Protected growth, which the 5-year strategy on the index annuities sits very nicely in. The bank notes, obviously 30% downside, and you can still make double digits. That's our protected growth bucket. We got our growth bucket, which is our individual equity strategy. That's third party, that has significant outperformance of the S&P 500 over since 1995. This is another hot button that you can't outperform the market. Well, this strategy since 95, net of fees, has outperformed the market by almost 1,200%. Past performance is certainly not indicative of future results. That is a must to know. But we like this strategy because of the computer quantitative nature, and we believe the process is repeatable. That to me is a big deal. Computers. They're doing things that the human eye can't see. And so they actually, this strategy has been utilizing. They were really the quant shop in the late 80s, early 90s that Wall Street used for research. And then they started managing money for advisors, I believe, in the early 90s. And so, again, you got our protected growth bucket, you have our growth bucket, our opportunistic growth bucket is our hedge fund, which we call Bison Alpha. Phenomenal strategy, in our opinion, gives you the ability to still, again, make money in down markets. We can obviously hedge. It's a relatively concentrated strategy, 15 to 30 names. I guess many people would probably laugh when I say concentrated because, concentrated to most people on Wall Street is 5 to 7 to 10 names. But we do believe that there is money to be made in a level of concentration, so 15 to 30 names. But here's the deal. It is giving you the opportunity to even make money in a down market. Again, the ability to hedge, the ability to use short-term trading strategies to offset risk or to take advantage of volatility. That, to me, again, in a single firm, we are bringing to you all strategies in one relationship. And so if you want to learn more about Bison Alpha, we don't talk a whole lot about that. We did just launch it. We are really going to put a push on that in 2026. We want to get that over 100 million as quick as we can. But again, if you want that type of opportunistic growth strategy, obviously that's the bucket that we have there. And then tax reduction alternative, private equity, which is our energy fund. And so when you look at what we are doing, when you look at why we are different, we have strategies that if you say, I hate the market, okay, great. Let's talk about our protected growth. Let's talk about 30% downside to still make double digits. Let's talk about the very short-term 5-year index annuity strategy that your worst year is zero. Your gains are locked in every single year, and it's tied to the price movement of the S&P 500. Well, then we have people on the other side. I think the market's going to continue to go up 30, 40, 50, 60, 80, 100% a year. Phenomenal. Let's talk less about the protected growth. Let's talk about the growth, and then let's talk about the opportunistic growth, which is our hedge fund strategy that is really designed to get after it, to deliver alpha, to make money, and yet still has a significant risk overlay. Well, I'm not worried about either of those. I just need tax reduction. I need a strategy that can be put, can still deliver positive returns, or a strategy that's not correlated to the S&P that can still do well. Okay, great. Let's talk about Bison 2. Let's talk about our energy strategy. Let's talk about if inflation is rampant, commodities are ridiculously underowned. let's talk about our energy fund. Let's talk about where we are partnering with the Exxon, Chevrons, Conocos, Occidentals of the world and the number one oil and gas field in the world, as I just said, in the Permian Basin, tier 1 acres of the Permian Basin. And let's talk about tax reduction. Let's talk about how we can reduce your taxable income by on average $80,000 to $90,000 per $100,000 invested, active income. So yes, if you're a high wage earner, if you make a bunch of money, if you sold a business, you had a liquidity event of some sort, if you put $1 million in, one of the Mag 7 and now it's worth 5, 6, 7, 8, 10 million, and you want to start diversifying out, number one is why don't you have a hedge on that? That is a whole nother conversation. But if you want to start diversifying out and minimizing your tax capital gains, let's talk about how we can strategically use Bison and we target double-digit returns independent of the equity markets. So when you look at what we are doing, protected growth, opportunistic growth, private equity alternative, I challenge you to find a firm like that is bringing you those strategies. They may talk it. They may say they can. But when you really identify, when you really look at the offering, it's just a closet index fund, some fixed income, some equities, show you a chart of 100 years of the market, go on your way, let me collect my fee. That's why we're bringing over the amount of clients that we're bringing over. So 630-492-1912, 630-492-1912. More after the break.
Are you close to or already in retirement and maybe you're not sure if your retirement plan is working as you'd hoped? Getting a second set of eyes on that plan is always a good idea. Call Robert Kuhn and his team at Kuhn Capital Partners for your retirement review. They'll be glad to sit down with you and talk about where you want to be in retirement and how to get there. So call today to set up your visit, 630-492-1912, and find out more at KuhnCP.com. That's KUHNCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, headquartered in Oak Brook, Illinois, just outside of Chicago. We are right across from the mall if you're local. If you're in other markets, we do have office in Dallas. We do have office in the Panhandle of Florida. Kind of those are the two markets that we've decided to really accelerate our growth in, and obviously each market that once we believe that it's stabilized, and then we look to go into another market. And we're doing that. We look at investing kind of as a sport, right? A sport. And we're very, very passionate about making sure that we are giving you, the investor, the ability to still reduce taxes, deliver positive returns in negative markets, and then really get after it as far as a bucket of money on the upside in our opportunistic growth strategy. And so we're doing something that I don't want to say we're the only ones, because I can't say that, but I can tell you that the bulk of almost every advisor that I know is not doing anything close to what we are doing. We are bringing four distinctly, uniquely different strategies in a single portfolio, or a single strategy with a single relationship with an overlay of financial planning and tax management that is very, very hard to beat. And so I think that is why that we have seen just absolutely the growth that we have in the markets that we've have really made a decision to participate in. And we're looking to continue to expand the radio show because that's our passion. Our passion is beating other advisors. And what that means is you win more. That's it. That when we win, you win. Because if we can bring you a strategy, if we can look at our clients and we can tell them, you can still make double digits as long as these indexes are not down 30%, that generally wins the day immediately. Now, we understand relationships. We understand people have been working with advisors for a long period of time and it's hard to leave, blah, 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 but this is your money. This is your money. And when the markets drop 20 to 30%, or the markets are down 40, 50%, or the markets are down subsequent years in a row, like early 2000, you don't want to just be sitting there with an advisor telling you, well, just sit and wait, it's going to come back. And 9 out of 10, that's their risk management. So 630-492-1912, 1912. Make sure you give us a call, set up your time, come into the office, do our Zoom, meet with my team. Not only will you be impressed with the asset management side of portfolio construction, when you look at the planning side, when you look at the tax software that we use, it's second to none. Absolutely, positively second to none. So 630-492-1912. There's, again, tax reduction. We're meeting a lot of people that have a lot of capital gains, significant amount of capital gains, because they have a lot of money invested in tech. And tech has absolutely done phenomenal. I'm not saying that tech is going to fall off a cliff. I don't know. You don't know. Nobody knows. And that's one of the greatest things about the markets is everybody, to make a market, to make a market, you have to have different opinions, right? Because for every buyer, there's a seller. For every seller, there's a buyer. And those individuals are probably, seeing the world differently. And the beauty, I think, of what we do is we're market agnostic. When we want to win no matter what. And that's it. I don't want to sit here and tell you that the markets are going to go up forever and then try to explain away why I was wrong if the markets are down. We want to tell you that, our equities might be down, but here's what we have in the portfolio that's actually done well and is actually making money or protecting your principal. And again, always look at investing through the lens of do not interrupt compounding unnecessarily. Not my line. It's the great late Charlie Munger's. I want you to look at your portfolio. I want you to ask your advisor, what do we have that can make money in a negative market? Can't be bonds. If that's the answer, it's just not accurate. You look at the bond market, we're on the worst drawdown in history of the bond market. You look at inflation. Inflation is still here. If you're buying these lifetime income annuities, I want to model out how inflation for you. I want to model out for you how inflation is going to reduce your purchasing power of that income, and I want to show you a better way. 630-492-1912. My team will do that. I love these statistics. I think it's really interesting to look at statistics. As many of you know, we're just kind of geeks like that. I think that's just our job. I think it is the job of an advisor to make sure that you have statistical analysis of a portfolio that can give a high level of probability of success when it comes to investing. And what I have found is the investors who know that they still have 10%, 30%, 50%, whatever that number is, 80%, that they know that their portfolio is going to make X as long as the markets don't do Y, they just have a better investing experience, right? That is the job. Our job is to make you money. That is our job. Our job is not to explain away why it's okay to lose money. And then when the markets do ultimately go down, which maybe it'll never happen, but when the markets do go down and your advisor is sitting there telling you it's okay to lose money and still pay me, right? That's not lost, shouldn't be lost on you. And then lay down a chart of 100 years worth of market data and tell you the markets will come back. Those are all true facts. But what if you have 40% of your money that didn't lose money? What if you had 40% of your money that still made double digits? What is that going to do? How is that going to offset the losses maybe that you're going to experience in the equity space? Well, what if you had strategies that weren't tied to the equity markets, that didn't have any very low correlation to the equity markets, meaning they're going to act independent of the equity markets in the energy space that is still cash flowing, targeted, 10 to 20% a year, regardless of what's going on in the equity markets and providing great tax benefits? What if you had that as a 5 to 10 to 15% holding as well? Well, all of a sudden, if the markets do go down, you can see how our conversations with our clients are significantly different than the bulk of conversations that are going to be had between advisors and their clients. Because yes, our equities are going to go down. Our growth bucket, if the markets are going to go down, they are going to go down too. Now, historically, they've gone down less than the markets, but yeah, they're going to go down. That is investing. But that's one of our buckets. That's 25% of our portfolio. What about the other three strategies? What about the protected growth that probably made money? What about the hedge fund, the opportunistic growth strategy that has the ability to hedge, that can bet against the market and clear trends. How did that do? What about the private equity energy strategy that is not, I hesitate to say it's not impacted by the S&P. I think everything is impacted by the S&P 500, but it is statistically not correlated to the S&P. But so we've got three different strategies, three uniquely different strategies that in a down market, we think you win. And in an up market, we think you really, really win. So those are the things that we need to talk about. That's why we do the radio. That's why we're trying to get on and looking at other markets. We're in the Dallas market. We're in the Panhandle market of Florida. We're looking at other markets actively to take the message to, because we're very passionate about helping you, the investor that has $500,000, the investor that has $50 million, the investor that has $5 million, the investor that is tired of cookie cutter strategies, the investor that wants their portfolios invested as the advisors would invest their own money. I mean, would it surprise you that the advisor that you're working with probably is investing his personal assets significantly different than how they're recommending you invest? I mean, think about that. I mean, again, I see it. And these are the things that resonate with investors. We're not trying to tell you we're the best things in the world, that we're the best advisory group, we're the best at this, the best at that. No. We're telling you that we don't know where the markets are going to go. We're telling you that the markets are going to go up and down. We're telling you that we can reduce your taxable income, that we can put predictable strategies in place in the bank notes. We can put predictable non-loss principal protected strategies with the 5-year index annuity that will just, in my opinion, significantly outperform any lifetime income annuity. We're telling you that we can put an equity strategy in front of you that has 25, 30 years worth of historical performance. Again, past performance is not indicative of future results, but has significantly outperformed the S&P net of fees by almost 1,200%. We're telling you that we have a hedge fund strategy that you don't need to invest hundreds of millions of dollars in, that has a significant risk management overlay that gives you the ability to really get after it when the markets are good, but also protect when the markets are down. That's what we're telling you. That is what we are bringing to the table, that I can promise you no other advisor on this radio station is doing. Absolutely not. Radio, TV, unfortunately, not just this market, most markets, their annuity pitches wrapped up as wealth management. And we're changing that. And that's what we're doing. We're not changing. We're very vocal about that, not to ruffle feathers, but I don't care, because my job for our clients is to give you the best opportunity to make money no matter what happens in the market. Tired of these basic sales pitches, tired of these cookie cutter portfolios, because the advisors still get paid in down markets. And when you lose money, and they did nothing to protect, they did nothing to add to your portfolio strategies that can deliver positive returns in negative markets, they did nothing to your portfolio that could greatly reduce your taxable income. We are talking active income. Bison 2, you've got till 12/31. Reduce your taxable income by $80,000 to $90,000. Investing in an energy strategy. Get into the data room. You've got time. Call us. We'll give you access to the data room. We'll talk about it. We'll help you understand it. If it makes sense to you, we'd love to have you as an investor. So hopefully this week you've got a lot out of the show. Is a little bit more on my soapbox than I am normally, but that happens. So hope everybody has a great week. 630-492-1912. 630-492-1912. More next week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.